We're now going to calculate the provisions against each one of those advances. What I have done here is this same table. I have created another table based on this and added a few more columns that will take care of, or that will show us the provisions that are to be calculated on each of these type of advances. So we have three types of advances: cash, credits, overdrafts and so on, term loans, bills purchased and discounted. I've done it exactly as per this working note, okay? And further classifications of those advances are given. So for each classification, we are going to calculate what is the rate of provision, meaning we will identify what is the rate of provision for each one and apply that rate, that is take percentage of each of these over here. Okay, so let us see now. As far as the rates of provisions are concerned, we have already discussed this and shown it to you before. That is, certain provision rates, certain percentages are applicable to each of these type of loans. Okay, like standard assets, for all type of standard assets is 0.4. If they are special loans like agriculture, commercial real estate, the rate is slightly different, but this is the standard rate. This is the normal rate on any loans that you are supposed to take for standard assets. Same way, if they are substandard assets, all these are NPA, substandard doubtful loss assets, then again there are certain rates, 15, 25 and so on. So let's apply these. Let's take the first one. In case of standard rates, standard assets, the percentage is 0.4, right, as per the chart, 0.4. Then in case of substandard assets, if it is secured, it is 15, unsecured, it is 25. So substandard is over here. Okay, under that secured is 15, like we have seen, unsecured is 25. Then doubtful assets, let's look at the rates for doubtful assets. If it is unsecured, it is 100, and if it is secured, it is 25, 40, 100. If it is 1 year, 3 years, more than 3 years. Alright. Now, in the problem, this is the adjustment. Doubtful are just given as how many are 1 year, 2 year, 3 years. But they have not told how much of these is secured and unsecured, right? But it's given in another working note here. Doubtful assets are secured to the extent of 50% of the amounts due. That means all these 50% are secured. That means out of 100, 50 is secured, 50 is unsecured. Same way 120, 50 is secured, 50 is unsecured. Okay. So accordingly, we're going to calculate these and bifurcate it. Fine. So what I will do here is doubtful assets, I will still make further another category and I will say secured in the bracket 50%, okay, and up to 1 year, 2 year, 3 years. Similarly, I'll make another 4 columns, 4 rows over here for unsecured. So I will say unsecured, they are doubtful debts only, we are still under doubtful debts, alright, correct. So these doubtful debts, part of them, that is 1 secured 50%, 2 unsecured also 50%. Okay, so what happens here is, again all these 3 categories will come here also. So out of all these 3 categories, part of them are secured, that is 50% are secured, 50% are unsecured. So how to bifurcate, how to divide them? 50, this is total is 100, right? So out of the 100, 50 is in the secured category, 50 is in the unsecured category up to 1 year. Same way, out of 20, 10 is in the secured category, 10 is unsecured, 50-50%, right? Same way here, if it is 120, then divided by 2, 60, 60. If this is 30, divide by 2, 30 and 30. Done? Then this is 50. So again 50%, 25, 25, and if this is 40, this 80, this becomes 40 and 40 over here. So it's a simple calculation, simple bifurcation. We were given total doubtful assets, 1 year, 1 to 3, more than 3 years, right? But they said out of this 50% are secured doubtful assets and 50% are unsecured doubtful assets. Now this is important because secured have a different rate of provision, this rate of provision, whereas unsecured has a different rate of provision. Let's look at it here. Doubtful assets, if it is unsecured, the rate of provision is 100% for all, and if it is unsecured, it is 25, 40, 100 depending upon the years, right? So what we do here is, this is the unsecured category, okay? These all are unsecured. You just highlight it so that you see it. Okay, you just highlight it like this. All these unsecured ones, the rate of provision on these unsecured will be 100. For all it will be 100. Whether it is 1 year, 3 years or more than 3 years, they are all 100. Okay. Whereas in the case of the secured ones, up to 1 year it is 25. 1 to 3 years it is 40. And more than 3 years it is 100. Done? So we have written the rates of provision for all. Substandard, the standard, substandard, doubtful but secured, doubtful but unsecured. And finally, what is the loss assets provision? Always 100%. If it is a loss asset, it is the provision to be made is a full 100%. Done? So these are only right now the rates of provision. Next, what do we need to do? Apply these rates of provision to the respective type of advances, okay, and write it in these columns. For example, let's say over here we are calculating provisions against cash credits, term loans and these bills discounted, right? So provision against cash credit is 0.4% of 1003. How much do you get? You get about 4. Round it up to the nearest figure. Okay. Like for example, you might get here 1003 multiplied by 0.4%. multiplied by 0.4, yeah, divide by 100. Okay, what you get is a 4.012. Round it up to just 4, right? Same way, the term loans, provisions against term loans will be 0.4% of 985. Look at the column of term loans, 985. So 985 multiplied by 0.4 is divided by 100 is 3.94. Again, round it up to the nearest decimal and make this also 4. Okay. So these are provisions. They are always going to be in some percentages because all these amounts are in thousands. Now, bills discounted also, calculate 0.4% of 433. So 433 multiplied by 0.4 divided by 100. 1.732, round it up to, let's say 2. 1.7, so round it up to 2. Okay. So like this, in a similar manner, we are going to apply all these percentages to the respective amounts over here. So again, 15% is the percentage applicable to this full row, all the types of advances. Alright. Now 15% of 80, you get roughly 12. Again 15% of 80. Understand, we are applying 15% to these. 80, 80, nothing over here, so nil. Then 25% of 40 is 10. 25% of 20 is 5. Last column there is nothing, so nil again. Let's come to doubtful assets. 25% of the 50 is 13 and 25% of 10 is 3. Nothing in the last column, nil. Now 40% of 60 is 24. 40% of 30 is 12. Last column, nil. 100%, very easy to calculate. Just write the same amounts of as this, 25, 40. Again 100% of 50 and 10. Again 100% of 60, 30, 25, 40, 12, 22. Okay, very simple. So the total calculation over here that we have done of each one of the provisions. Fine. So you get the provision for all of these, and we have provisions for each: cash credits, term loans and your bills. Okay. Time to total them up. We'll just remove the split view so that we get to see the entire working note at once. Alright. So here's what it looks like. Just join this. Yeah. So this is what it looks like. Your total cash credit column we have to total up, just so we know how much is the total provisions on all the cash credits, whether they are standard assets, whatever. Now it doesn't matter anymore. We have to make one total of all of these provisions. Okay. So in these three columns we will write the totals, the final totals of all, and we have in the first one 235. In the next one we have 178, and final in bills we have only 2. Okay. So these are provisions on cash credit, on term loans and on bills. Okay. In order to get the total provisions, total provision on advances, we want individual figures like these, and we also want one final total, so that we can show it in the provisions and contingencies in our profit and loss account, right? So the total provision on advances, my final solution here, is 235 plus 178 plus 2, and that gives you 415. Okay. The total of all the provisions on advances is 415. So this 415 is going to go in the provisions and contingencies. Now normally we would do this calculation. We would take total income, total expenditure, then minus the provisions and so on. Now in this problem we aren't really given any sort of adjustments related to how much is the profit and so on. Alright. So we will not be doing any of this calculation. We will directly enter our provisions and contingencies here in the profit and loss account. So profit and loss, provisions and contingencies, amount we calculated just now of provisions is 415. I will just write in the bracket here, working note 1, just for our reference. Okay, so 415, sorry, it's supposed to be in the the amount column. So 415 is the provisions and contingencies. Okay. What else? The adjustment we have done is going to come in two places. One, we have already put in the profit and loss as a provision under the profit and loss account. Next is the individual provisions on each one of these, that is this total of provisions for each advance. We have to show it in the balance sheet. Okay, so balance sheet advances, the provision for, let's split and check the provisions below. Yes, provision for, do not confuse, this is a different, slightly different order than this. The first one here is cash credits, provision for cash credits. Okay, so write it over here. We have already written the provision, then we already written the amount for cash credits, and you say less provision 235. This is of cash credits, isn't it? So balance that you get after deducting that is 1170. Write it in the next inner column. Next, 178 is the provision on term loans. Alright, so term loans is 1267 opening balance, provision is 178. Okay, in the outer column, just leave some spaces here so that we don't confuse the totals. In the outer column, total of these two is 1089. Done? After deducting the provision. Next, bills, the amount is 433 and the provision we have calculated over here is 2. So minus that 2. Outer column you will get 431. Total of all your advances after deducting the respective provisions comes to 2690. Okay, total of all these after deducting is 2690. So that gives you all your advances, okay, and complete adjustment with effect on both sides, the profit and loss, that is the debit side as provisions, and also on the credit side as advances.